Hello, how you doing today? It's Bradford Ferguson. I got a lot I want to share with you today. We're going to be talking about the wealth multiplier effect. 4 steps to save millions in fees and mistakes by getting an extra 4% per year. So just imagine if you have $1 million account, if you have $1 million net worth and you're leaving a $40,000 check on the table every year. I'm going to show you how this happens. But just imagine that you're not cashing that check, you're just leaving it on the table. That's what we're going to talk about today. So let's first talk about who this is for. You're worth at least $1 million on paper. So we're talking about your net worth, which is your house minus your mortgage, plus your savings accounts, investment accounts, anything like that. You need your money to grow and multiply so you can enjoy your lifestyle. You want your money to be working hard for you so that it can outlast you and you're enjoying it along the way. You want to maximize your wealth, which means getting the growth you should be getting, and you want to minimize your risk of running out of money or having to downsize your lifestyle. So here's what we're going to cover. You're going to discover the missing piece that's covertly sapping 4% of your growth per year and how to recapture that 4% so you're not burning your money literally. We're going to talk about the difference between the predatory sharks that want to take a huge bite out of your wealth and the dolphins that will instead help and why that matters. You're going to learn how our wealth multiplier effect works, how we manage the assets, and how we find good investments. And you're going to learn how to take simple action to protect your wealth so you can secure your spot today among the elite 0.1%. We're talking about the group of millionaires that truly makes it work. Our promise to you on this presentation is to show you how to give your wealth the best chance of doubling every 10 years without leaving money on the table. This is not about get rich quick. This is about getting wealthy slowly and staying wealthy. Let me check in with you before we get started. Maybe this is you. Do you ever lay awake at night worrying about your money? Worrying whether you're doing the right things with your money, given everything that's going on with geopolitics, the economy? Maybe you have a business or your job, your family, your personal situation. Do you feel overwhelmed and struggle with the complexity of the financial world? There's all this advice out there everywhere you turn, all the news media, all the TV, everywhere. And you feel it's overwhelming because you're getting conflicting advice. Do you ever open up your investment statement and you're disappointed that you're not getting the kind of growth you need for your lifestyle? Do you feel like you're in a catch-22, that you can't trust anyone because of what happened in a financial crisis, or you trusted people in the past and they let you down, and you know that there has to be a better way? Or you know you could be doing better and you're thinking, I just want my money to grow. I have good news. If any of these is true for you, these are not the real problem. These are just symptoms of a larger problem. Once you make the 4 shifts that we're going to talk about, we believe you'll sleep better at night knowing that your millions are being well protected, that you're not taking unnecessary risks. You can say goodbye to anxiety and doubt because you'll have clarity that you have someone doing the right thing with your money. We believe you'll be living life the way you want without having to waste the time stressing over it, and use your time for what's truly important to you. You'll finally feel more mastery over your finances, and you can get your wealth to be multiplying again so you can relax and enjoy your money. That's what it's for. It's for what's important to you and enjoying it. Really quickly, before I get into what those shifts are, I want to talk about who I am so you know why you should listen to me. I'm Bradford Ferguson with Halter Ferguson Financial. I help millionaires unlock the full potential of their wealth and sidestep making costly money mistakes. As of the beginning of 2018, I work with over 200 individuals and families and manage over $157 million. I'm a Chartered Financial Analyst charter holder, which is the gold standard designation in the investment world, as rated by the Financial Times and The Economist. This designation specializes more on the investing side. It's common for mutual fund managers and equity analysts to also have a CFA charter. Halter Ferguson Financial, in my opinion, has a proven track record. We're ranked as a top 10 best financial advisor for 3 years in a row in Indianapolis by advisoryhq.com. This is not a paid rating. So here's the disclosure for the 2017 rating, but 2016 through 2018 is when the 3 years in a row. Let's talk about how I discovered the 4 shifts. So let me share my experience working with clients during the financial crisis. What I noticed is that there were clients who got overly emotional during the financial crisis. They got extremely scared. They got whipped up into this panic by the media. And what they did is they didn't trust us 100%. They let their emotions get in the way. No matter what we said, it didn't matter. What they ended up doing was ordering us to sell out of their investments completely at the bottom of the market. And what happened is because the market rebounded in such quick fashion, these people permanently lost 40%. This loss got locked in forever because they were never able to make back that money. They had to start over in a way. So those that trusted us completely and were comfortable with their investments, we helped them save 40% by keeping them invested in the market. And their wealth continued to multiply. So what we found is that there's a difference between those that make mistakes and those who do not, and those who want to beat the market and those who do not. And what's at stake is if you're not doing this right, your wealth isn't going to multiply as quickly and as powerfully as it could otherwise. There are 4 key shifts you must make to take advantage of the wealth multiplier effect. Once you adopt the 4 shifts, in our experience, you will multiply your millions, save on endless sleepless nights, and on decades of uncertainty. I don't want you to have to open another statement where you're disappointed with the growth you're getting, nor do I want you to leave money on a table. So the good news is we're going to walk you through all 4 of the shifts today. The first shift is called Stop Burning Money. This is all about not leaving that money on the table that we're talking about. This makes all the difference between the millionaires and the billionaires, the Warren Buffetts and those that aren't. So what we're talking about is if you have $1 million portfolio and you make a $40,000 a year mistake. So that's like not cashing a check for $40,000 each year and letting that check sit on your table and expire worthless. Like, who wants that? You wouldn't do that. So what am I talking about? There are countless studies out there that show the average fund investor underperforms the index by between 4 to 6% per year over very long time periods. These studies are done by a company called Dalbar. But these studies aren't comparing apples to apples. The cool thing is on Morningstar.com, you can look and see how a fund does versus how the investors in that exact same fund have done over different time periods. So if over 10 years ago you put your money into the Vanguard S&P 500 fund and didn't touch it, you would have averaged 8.4% per year. But investors in the same fund only got a 4.0% return. So this isn't about fees. This fund is a very low fee fund, and the 8.4% per year that the fund did includes that fee. So investors in this fund left 4.4% on the table. So who did this? So the average investor in a fund like this is someone who is smart and successful and can afford to save the money. So we're talking about the top 10% of Americans that can control 70% of the wealth. These are people like you and me that worked hard to save the money and are trying to invest it to earn growth so that your money works hard over time. All of us have made a mistake like this over the years. But what these studies show is that investors leave 4% per year on the table. So how does this happen? What happens is people get fearful and they sell at a low price. When there's uncertainty in the markets and the markets go down in price, people get scared and they sell out, just like I told you about the financial crisis. But also people get overly excited and they buy at high prices. And the other piece here is that people are trying to beat the stock market. The very act of trying to do that, it causes investors to underperform. So let's unpack this a bit. And also, we're going to see what it means on paper when this actually happens. A lot of these studies miss this crucial link of what actually happens in a real portfolio. So it all comes down to human instinct. On a primal level, we treat our investments the same as we treat our persons, our safety. So just imagine if you're in a forest fire with a loved one, be it a partner, a spouse, one of your children, or some of your friends. You're in this forest and then suddenly there's this forest fire that springs out around you. And luckily there's an exit so you can run away. So what you're not going to do is sit there and think about what you should do next. You're going to get the heck out of there. So what happens is the terror and fear overtake us. We just don't stop to ask questions or be logical. It's a totally emotional decision that's made. The truth is, a vast majority of our decisions are made on an emotional level. Now, some of us who are analytical like me don't like to think that we make emotional decisions, but that's the truth. The interesting thing is unlike with retail, when something goes on sale, 50% off, and a liquidation sale or whatever, we all scramble to buy it as quickly as we can. But with investments, when investments are 50% off, we get scared. And we also get stressed. And when we get stressed, we tend to shut down and we give up on ourselves. We get a bit snake bitten. And then we give up on trusting people or give up on the financial system. And we say it's just not for us. So let's look at the flip side of this, which is running with the bulls. Excitement is a close but opposite companion to fear. So excitement also leads to euphoria and greed. We don't like to think of ourselves as greedy, but the opposite of fear is greed. So greed is when you're feeling good and you're running with the herd, you're running with the bulls, and you feel safe because you're in the herd, and you feel like wherever the herd is going, it must be good because that's where everyone else is going. But you are not a bull. And we also don't want to be a lemming. If we're a bunch of lemmings, we're not just going to run off the cliff. We're talking about our life. We're talking about our life savings. We're not just going to trust it with the groupthink. But again, this is an instinctual human emotion that's going on here. Similar to the running with the bulls, we have this fear of missing out. Now here on the screen, I have a picture of 4 fishermen that are learning to fly fish. But let's just pretend that we are fishing and we go to this watering hole and we're looking to catch some fish, and we see all these people fishing in one spot, and we think to ourselves, there must be a lot of fish there. That must be where people catch a lot of fish. So I'm going to go fish there too. And what's driving this is we don't want to miss out on the opportunity. We're afraid that we're going to miss out. Now, when we fish where everyone else is fishing, it seems less risky because that's what everyone else is doing, but it's actually more risky. We're going to spend a lot of time, and the cool thing is we'll get to socialize with all the other people fishing, but we're going to end up with less fish. What that means in your investment portfolio is more risk and less return. When we fish where everyone's fishing and we're running with the bulls, what we're trying to do is beat the market. This is exactly what the big banks and insurance companies are preying on with all their marketing. So what we want to do is we want to avoid the mistakes, and we don't want to obsess about trying to beat the market because it actually causes you to underperform. Let's look at what this looks like in a real life scenario. So what I've done here is I've taken someone who's 55 years old with $575,000, and if they didn't make the mistakes, they follow the gray line here, the gray bars. And what we see at age 65, they get to $1 million. Once they hit 65, they start drawing $40,000 a year from that $1 million portfolio. What we see is when you're not making the mistakes, the money continues to grow and the amount you spend continues to grow with inflation. But what we see here with this chart with do-it-yourself, which is the red bars, is that the cost of these mistakes, leaving 4% on the table with stock funds and leaving 1.5% on the table with bond funds, the cost of these mistakes is huge. It's over $2 million of value lost over your lifetime. You're running out of money at the end of your life, or your spouse is, or you're having to depend on your kids, or you're not leaving money behind for your kids. The real tragedy here is that you bothered to save the money to provide for yourself in retirement or when you no longer want to have to work. But by making these mistakes, you're causing yourself to run out of money, and you're having to cut way back on your lifestyle in your 80s. Who wants that? Not me. So you might think, okay, if do-it-yourself is doing this, what if you work with a broker? What we find with brokers is that it tends to be more expensive to work with them. They might charge you 2% in commissions, but also during the financial crisis, what we found is brokers only prevented about half of the mistakes that the do-it-yourselfers made. So when you add the 2% in commissions and only make half of the mistakes, you're still putting enormous pressure on the portfolio. And you're losing over $2 million over the course of the rest of your life. Again, this means not having money at the end of your life, not being able to take care of yourself. So let's instead look at working with a fiduciary, and I'll explain what that means later. When we look at working with a fiduciary, you're paying about a 1% fee per year. So the fiduciary is going to help you not make those mistakes. So you can't just go with any fiduciary, but one that's aware of this problem. So what we see is that you're able to spend the money in retirement, and your money is still growing over time. And you're saving yourself millions in fees and mistakes. You're literally cashing those checks that are being left on the table. You're no longer letting them expire worthless. You're taking it to the bank. And that's what we want. So I believe having a fiduciary is like having fire insurance. It's insurance against panic and uncertainty, against getting overly excited. But you don't want just any fiduciary. You want one that's going to put all the pieces together. So again, on $1 million portfolio, leaving 4% of your money on the table is like not cashing a check for $40,000 every single year. Every single month, every single day that you let this continue, you're costing yourself everything, because we know with interest, when the compounding is working in your favor, it multiplies your wealth. But when you're compounding in the wrong direction, it destroys wealth. So you got to say enough. There has to be a better way. So we're not going to make mistakes by selling due to fear, or buying because we're excited and euphoric. But then where do you turn? What most people turn to is a financial professional. But what we know is that most financial professionals are sharks. So you have to be very careful on who you choose to manage your money. So 98% of you listening to this are swimming in shark-infested waters. So Tony Robbins, in his book Unshakable, interviewed over 60 billionaires, and he asked them what advice they would have for people that are looking to build their wealth. And almost uniformly, what they said was, you need to have a fiduciary that's looking after your wealth, growing your wealth, and protecting it. So what Tony did is he dug into this topic of fiduciary, which we'll explain in a second, I promise. What he found was that of the 300,000 financial advisors in the U.S., 90% are commission only, which means they have a conflict of interest. And if they don't sell you something, if they don't put you into an expensive financial product, they're not getting paid. Then of the remaining 10%, 8% are what's called fee-based, which means they make money on both fees and commissions, but these people are double dipping into your pocket. They're charging you on both fees and commissions. Now that leaves the top 2% who are fee only, which means the only way they make money is when their clients pay them directly, so they have no conflicts of interest. You can't just go to the local guy because there's a 98% chance that he or she is making money on commissions and isn't giving you independent advice and isn't acting in your best interests always. So let's just look at this visually for a second. So as you can see from the pie chart, 90% commissions, 8% commissions and fees, and you have the top 2% who are fee only. This is one of the things that makes us different. But let's talk about the brokers for a second. It got so bad that the government created the fiduciary rule to hold brokers to putting the best interest of their clients first. This was a Department of Labor ruling that came a couple of years ago. But what the brokers have done is lobbied and fought against being held to this high standard. They fought against putting the best interests of their clients first. And what's ironic is they've gotten a favorable court ruling where the judge said it would be unreasonable for brokers to put the best interests of their clients first. Really? So my question to you is, do you really want to trust the broker industry with your money? An industry that's fighting being held to the highest standards? I don't think so. So if a vast majority of financial advisors out there are sharks, what can you do instead? Well, some people want to just set it and forget it. So they think, well, if I just invest in index funds and forget that I have them, then I'll be okay. Then I won't make the emotional mistakes. But you remember that fund in the example before? The Vanguard S&P 500 fund is actually an index fund, and people didn't forget they had it. And in the example, 4% was still left on the table. The other popular workaround is people say, well, I'll just have a robot manage my millions, and they call this the robo-advisors. So it's similar to an index fund strategy and the robots making slight changes over time, but it's the same premise. And what happens is, under times of stress, you remember that you have index funds. You get fearful or you get excited and euphoric, and you go to that filing cabinet or you go wherever it is, and you make a mistake with it. It's so bad with robo-advisors that whenever the market is down more than a few percent in one day, they actually shut down their website to prevent people from going into their accounts and selling everything. This has happened every year since robo-advisors have been around. So you might be thinking, what what can I do instead doing it myself? But, as we've shown you, you're playing against yourself. The house is stacked against you. You're playing a high stakes game against your own instincts and emotions. Your own instincts are going to tell you to do the opposite of what you should be doing. And when the pressure's on, when you're no longer working or you can't make as much money or you're worried about your job or your business or geopolitics or the economy or whatever, you're going to feel this tremendous pressure to make mistakes. The pressure just goes way up. You might think that you haven't made many mistakes so far, but that's going to change when you can't just make more money or work longer or catch back up. So what we want to do is we want to stop being the prey to these sharks, because when you feed the sharks, you end up with huge hidden commissions that amputate your wealth. And what we know is that the sharks will prey on your emotions at critical turning points when they should instead take a stand for you. So during the financial crisis, what that means is you're overly fearful and you're wanting to sell, so you call them up and they're just going to sell it for you. They're not going to stand for your best interests. And the reason they do this is because it's easier to just go along with your emotions. Additionally, what we know is if you go it alone, you're risking it all. Because what the financial crisis showed, and there are studies on this, is that do-it-yourselfers made twice as many mistakes. So 18% of do-it-yourselfers made a huge mistake in the financial crisis, whereas 8% of those that had advisors. Let's look at a case study when a client of ours received an inheritance. So we have a client that's a son of a long-term client that's been with us for nearly 20 years. So this is a multi-generational client. And we actually manage money for his son now. So there's 3 generations in this family that we're helping now. What happened is his mother-in-law passed away suddenly. And he was looking into her accounts and he saw that the broker charged her sick mother 3% in commissions in 6 months by making changes in the account and earning a commission on each trade. Now, if you annualize that, that's 6% a year in commissions. I won't name the bank that did this, even though I wish I could. It's really bad what they did. But what's worse is that the broker had her in a growth-limiting, flavor of the year, income-only strategy that limited her growth and limited the money that went to her heirs. So the result is that our client had us manage this money as well, and we moved it from a growth-limiting strategy to one that embraces a growth mindset, but also limits the fees because we don't charge on commission. I'm limited what I can say here, but we got it back to growth. So what's the answer if making these mistakes is costing us some money and trying to beat the market is causing us to make these mistakes as well, and we don't want to work with a shark and we don't want to do it ourselves? What can we do instead? Real quick, before we get into that, let's talk about doing things the old way. So you might be doing it yourself, or maybe you did this at one time before you had an advisor. You're reading, you're researching things and listening to the TV and the radio and reading your investment newsletters of the gurus and the endless articles online. And they have the fake bull bear debates on TV every 5 minutes. And the news is overhyped about why the market's down one day versus up the other, constantly coming up with reasons why you should be worried. You got all this literature out there from the newspapers that has all the advice, the magazines, the books, the radio shows, which make you feel smart to listen to. And you got this trading software which makes you feel in control. It's kind of like the Starship Enterprise if you ever look at one of these trading softwares. But all it is, it's the illusion of control, the illusion of knowing something and doing something. But what we end up with is this fear of missing out and these underwhelming, poor results. So instead, what we want to do is multiply what works. So we're avoiding the life-changing financial mistakes. People aren't making those investment mistakes every year. They're making it every few years, and when they do, it's very expensive. We don't want to try to beat the market because it's those emotions that are causing us to make those mistakes. What we want to do, if we can, is we want to gain access to elite investment managers, embrace the art and science of investing, because the emotions are more of the art and the psychology of the market is more of the art, and leaning against that is more on the art side. And then you have the science of investing. You can't just do one or the other. So if you don't want to be doing it yourself or working with a broker, instead what you can do is invest in a financial warrior. And we're going to talk about all these things, but a financial warrior is a fiduciary, someone who is fee only and doesn't have any conflicts of interest, but also puts all these pieces together. You got to check all the boxes. So what does it mean to have access to elite investors? So because of our size, the history of our firm, and the relationships that we have access to investment strategies that are closed to other investors. We follow elite investors over time, get to know them and understand them, and we follow them almost wherever they go. So when we're looking for elite investors, we're looking for investors that perform on an Olympic level. We're looking for the top 0.1%. There are so many investment options out there. Finding these elite investors is like finding a needle in a haystack, but it can be done. So this isn't just looking for the funds that have the hottest performance over a 1, 3, or 5-year period. This isn't the hot sector fund or the strategy that you haven't been using, but then you realize that it's done great over the last 5 years. What we're instead doing is we're looking for consistent performers that have a repeatable process. And these investors, these managers, must be good stewards of our wealth, which means they're going to invest alongside us. They're going to have a large percentage of their personal wealth invested in the same way because they believe so strongly in it. We also want them to be mindful of the price that they pay and not just pay any price because the investment's going up in value. We don't want them to fall victim of this euphoria that we were talking about earlier. We also want them to have an agile mindset where they're learning over time, their thinking evolves over time, and they're not staying in dogma, and they're investing for long-term growth. So that's what we're looking for with elite investors, the consistent performers with repeatable processes, good stewards, and wanting the growth. So let me step back for a moment and talk about why we invest the way we do. You might already know all this. These are things that are important to remember, especially in times of stress in the market or stress in your life or stress with your business. So we want to step back and look at why we're investing. We're investing for growth. We need long-term growth to fund our financial goals. So in order to get that growth, we want to be an owner, not a loaner. When you own a business or a property, you get the rewards of participating in the growth engine of the economy. So that means the profits of the businesses, the increasing values of the business or the properties. So when businesses are doing well, you want to be an owner. And what we know as owners of stock is we usually aren't going to own enough of a stock like Warren Buffett does. We're not going to own enough to tell management what to do with their profits or cash. but you're still an owner. You're still on the owner side of the equation. When you have bonds or cash, you're actually loaning your money to businesses and property owners, banks and governments. When you're a loaner, your growth is limited or even non-existent after inflation. So we want to lean heavily toward being an owner, but I'm not saying just be 100% in stocks, because that can be hard to do. The real risk in investing is not getting enough growth to fund your financial goals, to do fun things with your money, to enjoy your lifestyle, to use your money for important things like family or charitable causes or legacy. For all those things, you need your money to be growing as much as possible, as much as you're comfortable with. So basically, you want your money to work hard for you because you've worked hard for your money. So when you don't get enough growth, you're guaranteeing that you'll fall short financially. You're not going to be able to meet all your financial goals. You're going to have to cut back on your lifestyle. So that's not just moving into a different property that costs less, that's cutting back on everything. That's the situation that the other 97% of Americans face. They have to downsize significantly when they can no longer just make more money, or they no longer feel like working. But if it was easy, everyone would be doing it. In order to get that growth, you have to tolerate the ups and downs of being a business owner. So as we know from the stock market has its ups and downs. And whenever it's doing either one, the media is in this whole frenzy about why you should be excited or scared. And it's similar with being a business owner. There's cycles and phases and seasons to businesses and to investments. And it's not easy to go through those phases without some emotion. When we're in the winter of our business or the winter of our investments, it can be hard. If it was easy, there wouldn't be this huge upside benefit to being an owner. The other kind of risk is permanent loss. But you can easily avoid permanent loss by simply staying diversified. But it's hard to stay diversified because every quarter that goes by, you have one investment that does better than the other investments. So the temptation is to sell the investment that did the worst and add money to the investment that did the best. And that's probably where we've all made mistakes in the past, is it's very tempting to do that. So again, the real risk is not getting enough growth from your assets. So what you want to do is put all the pieces together and embrace the wealth multiplier effect. What this means is, and what this process looks like, is first we start with mindset. Ultimately, you got to be comfortable with your investments. We talk about your history as an investor, when you started, what changes you made along the way. And what we found is people's risk tolerance really doesn't change a whole lot when they reach a certain age or when they retire versus working. And once we know all that, we have your context and we can tailor the investments to you, whether you're a more conservative investor or more on the aggressive side, or if you like to stay in the middle. So the second step is that we invest the money. And what we want to do is invest where the puck is going to be, a la Wayne Gretzky. He said, you want to skate where the puck is going, not where the puck has been. So this part is part foresight, part intuition, and part science. So we're combining the art and science of investing here. We're mindful of the risk being taken, but we want to invest for the next 3 to 5 years. So we're not investing for what's done well the last 5 years. We're investing for what we think is going to get us a reward for the risk that we're taking for the next 5 years. The third step is direct. We talk to the elite managers and their teams. We want to understand their thinking, see what opportunities they are seeing in the markets and what risks they see, and also know what changes they're making. These are managers who have been consistent performers over time and good stewards of capital, so we lean on their thinking to help inform our own. Does that make sense? The next step is we make adjustments over time. We're always on the prowl. We begin and end each day with what's going on, wondering what impact the news has on our investments. So it's about what's next and where are the risks, and we adjust as the financial world evolves. And the last crucial piece is that we support you 1,000%, which means that we are the ear that listens to you. We teach and support and guide you over time. So what we know is that this is not a straight line. We're in a river of change. There's ups and downs to the market, your life, your money, and we're going to be right there with you, helping you along the way. So just know that you're never alone. Let's look at some simple math before we wrap up this section. What we know is that the cost of not putting all the pieces together is too great. If you find a fiduciary, but they don't understand that what you're trying to do is avoid the mistakes, by trying to beat the market, they're going to make those mistakes, then you're not putting all the pieces together. And you also got to find someone who is going to combine the art and science of investing. So if you made it to this point with $1 million, you may have cost yourself 30% or $300,000 already, just so in the past 10 years or so. We don't want to be leaving that kind of money on the table. So if you've ever looked at your investment statements and been disappointed versus what you know you should have done, you know what I'm talking about. So looking out 30 years from now, as we showed in the example, you could easily leave $2 million on the table. This is $2 million in uncashed checks. If you're talking about $2 million today, then just double these numbers. If we're talking about $3 million today, just triple these numbers, etc. You need your money to be compounding in your favor. Just like you know that high interest credit card debt causes your money to be destroyed, taxing your money by 4% a year is costing you everything. Let's look at another case study, the financial analyst. This one surprised me a bit, but it made sense after a while. So he's a financial analyst for a Fortune 500 company. Yet despite his training, he realizes he's not good at nor wants to handle his personal investments. So he had all this accounting background. He knows how to make projections, all that stuff, and he still didn't want to do it. And beyond multiplying his wealth and getting more growth out of it, what he wants to do is reclaim his nights and weekends for things that are important to him, like family, time with his twins and his wife, and time to exercise and enjoy his health. But just getting that freedom back meant everything to him. The final nail in the coffin is that every time he talked to his broker wanted to sell him an annuity or more insurance. Who wants that? Not me. So we're working together now, and he's been pretty happy. I can't really say much more than that because I'm not allowed to. So you may be asking yourself, what does Brad mean by fiduciary? What's he mean when he's talking about financial warrior? So I'm going to talk about that right now. It's about investing in a financial warrior. So what's a fiduciary? Well, your doctor's a fiduciary. You go to the doctor's office and they're going to ask you a bunch of questions, and some of the questions actually point to your future, like your family history. They're going to weigh you on a scale, and then they're going to do other tests and all this stuff. And your doctor's going to act in your best interest to the best of their training. What your doctor isn't going to do is necessarily choose the easy route. What they're going to prescribe is what they believe to be the most effective solution for the problem or situation that you have. Does that make sense? So a fiduciary always applies the principle of best interest, which is putting the best interests of their clients first. So always means putting your best interest first, even when you don't like it. So your doctor might say that you need to lose a little weight. So they'll tell you to eat less and exercise more. I don't know if that's very helpful advice, but they know you're not going to like that kind of advice. But they're operating in your best interest, so that's why they're telling you this. Sometimes we see with clients in our business is that they start to spend too much money, and we have to have an uncomfortable conversation with them around spending less money. These are conversations that our clients don't necessarily like, but we operate in their best interests. So we're happy to have those conversations because we're standing up to what's most important to you. So what a fiduciary is going to be is they're going to be the calm, rational voice in your life. With your finances, with your investments, they're going to be that in the financial storm. They're going to be that firm hand on the rudder. So you want to leverage the principle of best interests. You don't want to not leverage it. You don't want to be shark bait, right? So you want someone who will always work in your best interests, even when you don't like it. So let's talk again about the financial crisis. When the market seemed to be going down every day in early March of 2009, we talked to a lot of clients on the phone. People got scared even though they may have trusted us completely. And we had to have a lot of uncomfortable conversations with clients. But we were happy to do so because that's what they were paying us to do. They were paying us to be a fiduciary. They were paying us to act in their best interest, not just to do whatever they wanted us to do, because a lot of them wanted us to sell everything for them. But we talked to them about it and helped ease their fears, their worries, and concerns. What we know is a fiduciary also uses insight. They have insight into your needs and your priorities by getting to know you and knowing where your money intersects with your life. Because what we know is money by itself has no meaning. It's who and what your money is for. If we don't know what your needs and priorities are, then we can't be a fiduciary for the best interests of your needs and priorities. So if a client tells us that they don't want to run out of money no matter what, and then 2 years from now, they're spending a ton of money on a yacht that they can't afford or they want to, then we're going to know that that purchase conflicts with their priority of not running out of money. And we're going to have a conversation. So this insight also means that there's leadership to prevent costly investment mistakes. So this is about knowing when people are overly fearful, knowing when they're euphoric, and sitting tight in the saddle and keeping our balance. So it's part long-term thinking and historian. It's understanding how the psychology evolves and affects markets. Because as we know, markets don't always trade rationally. There's an emotional element to them. So I want to talk for a second and tell you about my firm, Halter Ferguson Financial. We were born in 1986, and it wasn't until 2002 that we became fee only. So we've been financial warriors for half of our life, just about. So we've been on both sides of this. So unlike brokers who've been fighting against acting in your best interests, we chose to go fee only in 2002 because it was the only way to truly serve our clients' best interests. It was the only way to hold ourselves to the highest standards so that we had no conflicts of interest. So there's no way we're going to put you into an obscure real estate financial product just because it gives us 7% commission, because we make no money on commission. We made this change to fee only as it was beginning to happen, because we realized that this was the way we wanted to be treated. So what this means is that we do things a bit differently, and we could be your financial warrior. So to recap, what we want to do is we want to stop making those mistakes, stop burning that money, stop costing ourselves 4% a year and leaving those checks on the table. And we don't want to feed the sharks, because what we know is the sharks charge a bunch of money and they're not going to prevent the mistakes. So instead, what we want to do is multiply what works, which is the wealth multiplier, which means we want to stop making the mistakes. We don't want to feed the sharks. We want to be aware of all that. We don't want to try and beat the market, but we also want to combine the art and science of investing. We want to look for elite investors that we can grow our money with, and we want to do all that at a reasonable price. And all that means is investing in a financial warrior that can take care of this for us. So you've been listening to me talk, and now you have a choice. You can either keep things the same, keep them the way they are, and risk everything, potentially leaving millions on the table, leaving those uncashed checks on the table, the stress and the worry that you're going to have, and opening those brokerage statements and being disappointed, having those uncomfortable conversations with your financial advisor where you're wondering what happened and they have all these excuses. Or maybe you're doing it yourself and you know you made some mistakes, you left some money on the table, but you thought, oh well, I did my best. But what you're potentially costing yourself is everything. You could cause yourself to have to downsize your lifestyle dramatically when you no longer are working or have to work. And you could be leaving a ton of money on the table. So instead, you can join the elite 0.1% out there, an elite group of millionaires who have this figured out. What they realize is that it's simple, but not easy. You eliminate the mistakes. You find someone whose interests are aligned with yours so that your wealth is multiplying in your favor. It's compounding in your favor. What that means is being able to live the life of your dreams with having the financial freedom to do almost whatever you want. If you want to join this elite group of millionaires, then here's what I have for you. My team and I have set aside time to speak to you personally so we can apply these ideas to your millions. Whatever your biggest challenges are, we've likely seen them and can help you overcome them. It works like this. You're going to get on the phone with us for about 60-minute phone call that could help you be able to double your money every 10 years and have the lifestyle of your dreams and continue growing your wealth. What we're going to do is give you a 4-step game plan to make all of that happen. So what's the cost? Well, it's absolutely free because we love working with people like you. This is what we're passionate about, and we hate it when people have to downsize their lifestyle. We hate it when we hear about people running out of money and having to be dependent on their family. We love connecting people's money with their dreams. Let's talk for a second about who this is for, because this is not for everyone. Now, you might not think of yourself as a millionaire, but you are a millionaire on paper. You're worth at least $1 million. That's your net worth when you look at your house versus your mortgage and your investment assets. And you don't have to have $1 million that's investable. If a bunch of your money is tied up in a 401k, that's cool too. This is for millionaires. And what you want is you want to maximize your wealth, which means you don't want your wealth to just coast. You want to make the most of it because This money isn't just for you, it's for what's important to you. And you want to minimize your risk of falling short. And finally, you're looking to invest in a financial warrior, which means you're saying to yourself, enough, there has to be a better way of doing this. So if this is what you want, go to www.hffinancial.com/wealth. Spaces are limited. There's only so many calls that we can take in a given day and still provide an elite level of service to our current clients. So when you go to www.hffinancial.com/wealth and you click on that, it's going to take you to our calendar. So you might see a yellow box, or you might have to write down that link, www.hffinancial.com/wealth. It's going to take you to our calendar, and it's going to show you open spots that we have. Pick the time that works best for you. After you pick out a time, it's going to take you to a form that's about 10 or so questions. Fill that out now so you can go into the call hitting the ground running. So I just told you about how you can save millions of dollars, literally. Save yourself all that stress, all that time worrying about it, and being able to lock in the lifestyle that you deserve. If you're tired of leaving those checks on the table, then go to that link, www.hffinancial.com/wealth. We'll get on the phone for about an hour or so. We'll talk about where you are today with your wealth, where you want to take it, and how we can help get you there. Again, I'm Bradford Ferguson. Thank you for attending this presentation. It's been a tremendous honor to share this with all of you. Go to hffinancial.com/wealth, and we will help you get your millions growing the way they should. It's been a pleasure sharing this with you. We look forward to talking with you soon. Take care. Bye for now.